Hello, my name is Bobby Pereira. My company is Chevron, you can see. So why should you invest in Chevron? Because we're the best. I wish I could tell you it was that easy, but it's not. I can't convince you this way. So let's dig into some formulas, some ratios, and let's get this. Starting with the DuPont analysis. ROE composition consists of the tax burden, the interest burden, the EBIT margin, the total asset turnover, and the equity multiplier. And we're going to look at all these relative to the Dow 30 companies. Let's start off with tax burden. Tax burden is net profit over pre-tax profit. Chevron actually has the third lowest tax burden among the Dow 30 companies. And the lower the tax burden results in a higher income, so that is actually very good for Chevron. It's a very good indicator that they're a profitable company, and if you're an investor, you want to invest in a company that has high income. Chevron's ROE is not driven by their tax burden, and this is also a good thing. You have companies that have high ROE, but their tax burden is what's driving it up. I'm going to show you right here the relationship. I took the 5 top ROE companies, the companies with the highest ROE, and Chevron is right here on the bottom. As you can see, the ROE and the tax burden for Chevron is the lowest. But if you look at Caterpillar Incorporated, you can see the tax burden is actually driving their high ROE, and their ROE isn't really that much higher than Chevron's. You could look at, let's see, another one, Boeing. Boeing has a really high tax burden, and their ROE is high in result of that. So you don't want your tax burden to drive your ROE, and Chevron's is not doing that. So let's go to interest burden. If you look at interest burden for Chevron, you can see it increased over a 5-year span from 2008 to 2012. This is actually relatively high compared to the Dow 30. Chevron took advantage of low interest rates. And I'm going to show you the interest rates in the next slide. But Chevron's ROE is driven by their interest burden. And here are the interest rates for 10-year Treasury bonds. You can see the rates fell in a 5-year period. And for Chevron, the interest burden actually rose because of they were paying less interest. They were taking advantage of the low interest rates. So that's also a good thing. Let's look at EBIT margin. The next 2 ratios are actually going to come together to form profit margin. So this is a profitability ratio. EBIT margin has increased over the past 5 years for Chevron in 2008 through 2012. Management was able to cut some operating expenses, so that's a good thing. And this did drive ROE for Chevron. Let's look at total asset turnover, which is sales over assets. Total asset turnover, really it picks up the revenue that Chevron is bringing in, and it actually has the 5th highest total asset turnover amongst the Dow 30, which is a very good thing. And total asset turnover is actually a driver of ROE for Chevron. And Chevron actually invested in assets that generate cash flows. You could get this from the high turnover or total asset turnover formula. Okay, so here is Chevron versus the Dow 30 average. This is the ROA for both of them. You can see Chevron is actually above average for the Dow 30. So there's that relationship. Equity multiplier. This is actually a measure of the firm's leverage and risk. Chevron's is actually pretty low. It's at 1.79, and it's well below the Dow average at 5.23. So they have lower leverage, but also the risk is lower too. So that's, depending on your level of risk interest, that's a good thing if it's low. Here's the relationship between the Dow 30 average and Chevron's leverage and risk in comparison. You can see it's much lower than the average. It's because of I guess debt has something to do with it. We're going to talk about that next, I believe. After this one. This is the supply chain management, I guess you could say it, slide. 233 suppliers and 56 customers. And from this you could easily see that Chevron is well diversified as far as their suppliers and customers go. We're not going to get into all the suppliers and all the customers. It'd be way too long, take way too much time. But you can see they're well diversified, and market risk does not affect them as much because of this. So that's why risk is lower in this company, because they're a lot bigger than other companies in the Dow 30. Drivers of ROE, just to recap for Chevron, their interest burden, their EBIT margin, and their total asset turnover was actually what drove ROE. It was not driven by tax burden or the equity multiplier, which is what we want. We don't want to be driven by the tax burden or the equity multiplier. Interest burden and the EBIT margin pick up operating expenses, and they contribute to the profit margin and the profit of the firm. So the fact that they are increasing over the past 5 years is a good thing. The total asset turnover, it picks up the revenue that Chevron is bringing in, so that's also a good thing that's driving ROE. The times interest earned ratio allows us to see if a company can meet their debt obligations. The higher this is, the more the net income. And Chevron actually ranks number 2 among the Dow 30 firms. So this is a great thing to say for Chevron. And a little quote I'll put up there, I don't know who said it, but it's true. It's not what you make, it's what you save that matters. So Chevron actually did a very good job at this. Here's the comparison, just so you can see it. Chevron versus the Dow 30 average on times interest earned ratio. You can see Chevron has a lot more control over their debt obligations than the average company in the Dow 30. Debt to equity ratio, Chevron is actually at 9.9%, which is relatively low compared to the Dow 30. And that's a good thing, because it means they're not paying too much debt for their equity. Let's look at the relationship here. You can see debt to equity on the right side and ROE on the left side. Actually, it'd be your left. So debt to equity on the left side, ROE on the right side. This is comparing the 4 companies with the top ROE in the Dow 30, as well as Chevron. Let's look at the debt to equity for a second. Chevron is really low in their debt to equity ratio, but if you come over and look at ROE, they're not really that much lower than the other companies. So you can see that these companies actually hit over 100. So they're taking in, I guess, more debt than they should, more debt than they can handle. But you can see the relationship here makes Chevron look really, really good in this aspect. So how does the market value Chevron? Well, if you look at the price to earnings ratio, it's relatively low compared to the Dow 30. It could be that the market underpriced and undervalued the growth of Chevron stock. And I'll show you the history of Chevron's growth in the next slide. But it also could be that they're not in danger of being overpriced, because, if anything, they're not in danger of being overpriced. The price to book ratio relative to the Dow 30 is actually pretty low. It could indicate that the stock is undervalued. So these 2 ratios could tell us just a little bit about how the market sees our stock. Here's the relationship for the price to earnings compared to the Dow. As I said, it is a lot lower than the average ratio for the Dow 30. Earnings growth rate, this is the past 5 years for Chevron. This is their earnings And as you can see, they're actually above the industry average. They're above the S&P 500. So past 5 years, and actually the past 10 years, they've grown a lot. Chevron dividend payout. Just to cover this a little bit, last week they actually raised their dividend payments to $1. They raised it by 10 cents. It was 90 cents. Now it's $1. It actually yields out to be 3.3%. And Chevron is actually, fun fact, Chevron is actually recorded to have 25 consecutive years of dividend increases. So to say that they're not going to continue this growth is a big statement to say the least. Okay, here is a little something. It's here it shows the 10-year growth in their dividend payments. You can see this is their industries, not the Dow 30. There's ExxonMobil, and let's see. This is the past 5 years, and this is the past 10 years. Okay, so you can see that they have exceeded everybody in their industry, and they're actually one of the top in the Dow 30. So that's a good relationship to show right there. And that's it. That was Chevron. Thank you for your time. Hope you enjoyed it. Hope you got something out of that.